In this chapter, we're going to start preparing something called a classified balance sheet. Now, as a review, where do we get the figure for retained earnings to go on the balance sheet? From the retained earnings statement. Good. If you try to pull it from anywhere else, guess what? You'll find your balance sheet does not balance. We're going to be preparing a classified balance sheet, and by that we mean simply that we have two groups of assets and two groups of liabilities. Other than that, the balance sheet is exactly the same as what we learned in Chapter 1. The formula still is assets equal liabilities plus stockholders' equity. Now we're going to have two groups of assets, though, and two groups of liabilities. So we're not changing the basics of the balance sheet. We're just adding some more subtotals, hopefully to make it a more useful statement to us then. The first group of assets is called current assets. Current assets are assets that we expect to collect in cash or consume in operations within 1 year. 1 year. So collect or convert to cash would be accounts receivable I expect to collect. Okay? Consume in operations will be like supplies or prepaid rent or prepaid insurance that I expect to use up within 1 year. We're going to list these in order of descending liquidity. Liquidity is how easy it is to convert something to cash. The most liquid of all of my assets is what? Cash. Now, I have a silly sentence here, but I'm going to tell you to ignore this one in just a minute, and I'm going to give you an easier one. Here's my first silly sentence. Can I run in school, please? Cash, short-term investments, receivables, inventory, supplies, and prepaids. Now, the reason I'm going to tell you to kind of ignore that sentence is what I normally use for current assets is the word CRISP. C-R-I-S-P. And the only difference between that and in this sentence is right here, short-term investments. Short-term investments is if I buy stocks and bonds of another company, and they would be short-term if I intend to hold them for a year or less. So if I'm Kmart and I buy stock in Walmart with the intent of only holding it for a year or less, that'd be a short-term investment. Now, I mention that because they throw it into a homework problem. But we're really not going to do anything with short-term investments. So if you want to remember the word CRISP, cash, receivable, inventory, supplies, and prepaids, that will be your best tool to help you remember what goes in this section and in what order. The second group of my assets is called property, plant, and equipment. Property, plant, and equipment, PPE. Here we're talking about long-term assets that we use in running my business. Long-term assets that we use in running my business, also called fixed assets. Every item in that group, except for one, will have some accumulated depreciation. The one that doesn't have accumulated depreciation is land, because land lasts forever, so we do not depreciate it. We're going to list these items in order of descending permanence. The most permanent of, let's say, land, building, furniture, equipment. Which is the most permanent of those? Land. What do you think is next most permanent? Building, and after that it's kind of a toss-up. Okay, land first, building second, and then all the other items in this group. Okay. So here's an example of one. Notice under current assets we have cash, receivables, supplies, and prepaids. We could also have some inventory in the middle there. We didn't in this case. Under property, plant, equipment, we have land, we have office equipment, and we've subtracted its accumulated depreciation. We figure a subtotal for each group, for total current assets and also for my total property, plant, and equipment. Or we'll refer to that as PPE sometimes. Under liabilities, we're going to divide our liabilities into two groups. Current liabilities and long-term liabilities. Current and long-term. A current liability is a debt that I have to pay off within 1 year. What are we talking there? Accounts payable, you better pay your vendors within a year, right? Wages payable, you better pay your employees within a year. Taxes payable, better pay Uncle Sam within a year. Long-term liabilities are ones that we're going to pay off more than 1 year from now. That could include a note payable, perhaps. A note payable can be a current liability or a long-term liability, depending upon when the note matures. If it's a 3-year note payable, it would be long-term. If it's a 3-month note payable, it would be current. Mortgage payable. Mortgages are usually 15, 30 years or such. That typically would be a long-term liability. Unless you're at year 29 and a half and your mortgage concludes next year, then it would become a current liability. Actually, with a mortgage, it's kind of interesting because every mortgage payment you make, part of it goes to principal and part of it goes to interest. The principal part that you're going to pay off within the next year actually gets reclassified from being a long-term liability to being a current liability. We won't be doing that, but if you ever see the account called current portion of long-term debt, that's the portion you're going to pay off within the next year. The other one we might see here is bonds payable. Let's mention that. Now remember, with notes payable, I borrow the money, I make no periodic payments. So if it's a 3-year note, for 3 years I pay nothing. At the end of year 3, I pay all the interest and the principal. Bonds payable are similar, a way of borrowing money. Instead, with bonds payable, though, each 6 months I pay the interest. Interest only, no principal. So each 6 months I pay the interest. No principal is paid until the bonds mature. So bonds payable are typically long-term unless they're maturing within the next year. So on the balance sheet, you see my current liabilities. I have accounts payable and wages payable. Under long-term liabilities, I have just my mortgage payable. Add them together to figure total liabilities. Haven't changed anything in stockholders' equity. Stockholders' equity is exactly the same now as it was before. Here's Walmart, just to see what one looks like in the real world. Notice under their assets, they have current assets. Cash, receivables, inventory, prepaids, property, plant, and equipment, land, building, furniture. Okay. All those items we just talked about. They have a few others as well. Current liabilities, short-term borrowings, accounts payable. Accrued liabilities would be like wages payable and interest payable and so forth. And then they have long-term liabilities as well, long-term debt. Equity section has not changed. The first thing I want to do is us to spend just a minute and write down in which section of the balance sheet each one of these items goes. So let's do the first one together. Let me put up here on the board the options. It's a current asset, or it's property, plant, and equipment. It's a current liability, or it's a long-term liability, or it's stockholders' equity. Those are your 5 options right there. Okay? So accounts payable, what type of account is accounts payable? Current liability. So let's just write a little CL beside it. How about accounts receivable? Current asset, good. Accumulated depreciation goes in what section? Property, plant, and equipment, good. It will be subtracted in the property, plant, and equipment section of the balance sheet. Contra asset, exactly. Bonds payable is what type? Long-term liability. Payable liability. Let's see, building is what type? Property, plant, and equipment, very good. Capital stock goes in what section? Stockholders' equity. Cash is what section? Current asset. Equipment is what section? Property, plant, and equipment, good. Land, building, furniture, equipment, all that's in property, plant, and equipment. Land is what section? Property, plant, and equipment. Land is unique in that this is the only item in that section that does not have accumulated depreciation. Merchandise inventory is what type? It's a current asset. CRISP, C-R-I. Mortgage payable is what type? Long-term liability. Good. Notes payable. What type of liability is notes payable? In this case, it's a current liability. Why? It's due in 6 months. What if it was due in 6 years? It would be long-term, so you have to see when it matures. Prepaid rent is what type? Current asset, good. Retained earnings? Stockholders' equity, good. Supplies, unearned fees, current liability. Now we're going to assume that we're going to do that work within a year. Wages payable, current liability. Better pay those folks within a year, I promise. All right, so now that we've decided what goes where, we're actually on the next page going to prepare a balance sheet. Okay, I've given you 3 columns for the numbers here. Let's start off with the word assets, and then we're going to list them. Current assets first. CRISP is my word for my current assets. C stood for what? Cash. Now let me mention, I'm giving you 3 columns for the numbers. Do you see that? Put this in the middle column. Cash, CRISP, C-R, what comes after R? Receivables. Now in our case, we just had accounts receivable, but we could have interest receivable. We could have notes receivable. C-R-I, inventory. C-R-I-S stands for what? Supplies. And CRISP stands for prepaids. So we're going to list those items, add them all up to get a total for my current assets. My second group is called what? Property, plant, and equipment. PPE, property, plant, and equipment. We're going to list items here in order of descending permanence. The most permanent of all my assets being what? Land. Good. The next most permanent being building. Now watch my columns right here. Nothing magic about it, but I want you to look at the columns. Building has what else that goes along with it? Accumulated depreciation. Everything but land has an accumulated depreciation. So see, I moved that number over to that leftmost column. All right, why is that? The building cost me $42,000. Directly beneath that, I'm going to list my accumulated depreciation. 42 minus 11 gives me the 31,000. Who remembers what we call that 31,000? Very good. Book value. What's another word for it? Carrying value is the other one. All right, land, building. What else do we have that goes in the PPE section? Equipment. Good. Same thing. Cost me $17,000. From that, I'm going to subtract its accumulated depreciation. 17 minus 7 says I have a book or carrying value here of 10. When I go to figure my total property, plant, equipment, these are the numbers I'm going to add up, the 16, the 31, and the 10. So my current assets are $9,300. My property, plant, equipment is $57,000. If I add those together, then I have $66,300. And that's my asset side here. All right, assets equal what? Liabilities plus stockholders' equity. Let's write that next. Liabilities plus stockholders' equity. Liabilities first, so let's write the word liabilities. Under liabilities, we're going to divide those into two groups. The first group is what? Current. Ones I have to pay off within 1 year. Or it could be I have to perform a service within the 1 year if it's the unearned. What sort of current liabilities do we have in this example? Accounts payable, notes payable, good, because it was due in 6 months, right? How about wages payable and unearned fees? Good. The assumption with those unearned is that we're going to do the work within 1 year. So we had 4 in this case. My total current liabilities are $14,400. Next we have our long-term liabilities. Long-term liabilities. What do we have that was long-term? Bonds payable and mortgage payable. And I really don't have any particular rules about the order in which you list the liabilities. Okay, because I've seen different books, I always do it differently. So we get a total for each category. And then we see my total liabilities in $22,800. All right, the good news is that we haven't changed anything in stockholders' equity. Haven't done anything to that. What two items go in stockholders' equity? Capital stock and retained earnings. Good. Nothing new about stockholders' equity. So if I take the total amount of my liabilities, I add to that the total amount of my stockholders' equity, we see that that total again is $66,300, which is exactly the same as it was for my total assets. And that's my classified balance sheet. Have we changed the overall formula for the balance sheet at all? No. It's still assets equal liabilities plus stockholders' equity. What we have done is to break down our assets into two groups, current and property, plant, equipment, and break down our liabilities into two groups, long-term and current liabilities.